Hey guys, and welcome back to the Young Investors Podcast. We're at episode 42, and joining me as always is Brandon. How's it going, Brandon?
Yep, I'm going well. I just woke up, so a bit tired. Do you find that like when you first wake up, your voice is like a bit deeper and a bit like croaky, and then you get into it and then it warms up?
Yeah, absolutely. I should probably listen back to some podcasts. There's probably a few of them like that. This one will be like that.
Yeah.
Just like the first 10 minutes, just like, hey guys.
Just trying to wake ourselves up. It's good to do it in the morning though. It's so much better.
It is.
Remember that time we
Yeah.
did the podcast in the afternoon?
Yeah.
Oh.
That was not fun.
We made so many mistakes. We would just like mess up forget what we were talking about, mess up our sentences. I remember that editing job was a nightmare. So it's definitely better that we do it in the morning. But yeah, why aren't we doing it on Saturday? You off somewhere, are you?
Yeah, I'm going on a bit of a fishing trip. Actually,
Oh,
so,
nice.
hopefully catch something.
Yeah.
Probably not though, knowing my track record.
Catch something. That's your goal, to catch something. Something that's a fish.
Just anything. Anything that moves.
Do you go fishing much?
No, not very often. No,
right.
but
Yeah, me neither. Yeah. Me neither. You're a murderer. That's what my girlfriend would say.
Oh dear, I'll put him back.
Sure. So this week we should say we're going to be talking about second week of earnings season. Even though some of these, one of these companies I know at least didn't even report this week. It reported a couple of weeks ago. But what companies have we got to look at today?
Yeah, so last week, if you didn't catch it and you want to go check it out as well, that's another one you can watch. Last week we did Facebook, Amazon, Tesla, and Google.
Yeah.
And this week we're going to go through Apple, Texas Roadhouse, Netflix, and Beyond Meat. So a little bit of something for everyone there.
Yeah, for sure. Yeah, and we're not doing the indices today because we are recording it on a Thursday. It's been like, what, 4 days since... Yeah, 3 full trading days. It's just like pointless. So with that said, do you want to just get started with the first company?
Yeah, for sure.
All right,
just before we have the companies, one tiny little bit of news.
Yeah. Of course, sorry.
I noticed this morning, and that was that the US Fed cut rates for the first time since 2008.
Oh.
So that's kind of a bit of an interesting story. They cut rates from 2.25% down to 2%. And the chairman's reason was due to some concerns about the global economy. He didn't really elaborate. I mean, I didn't read too much about it.
Yeah.
I just woke up this morning to it. And also just the low inflation. And that's been the same story with Australia, is neither the US or Australia has had very much inflation at all. And
true.
It's just been below the target for both of those countries, and they're trying to get it back up. So they cut rates for the first time since 2008.
Yeah, so they cut rates and try and stimulate the economy a little bit.
Right.
Yeah. Okay.
And we'll see what happens. But the other thing is that because they're cutting rates while there's no recession, it kind of makes people nervous, I think, about why they're cutting it. What are they seeing that the rest of the market isn't seeing? And the market was actually down in the US as a result of this, which is usually unusual.
Yeah.
Usually unusual. I saw an article a month ago that's basically said every time that the Fed had cut rates when there wasn't a recession, just mid-cycle, just in a bull run, the market had always gone up. So they were basically like, if they cut rates, it's really positive for the market. But interestingly, the market didn't like it. So yeah, there you go.
Is it maybe because the people see it as the Fed going, we gotta prop this thing up a little bit here?
Yeah, I think that's probably true. Yeah. I mean, I guess we'll kind of see what happens over the next few weeks. Just one day.
Yeah, of course.
It's a bit hard to judge.
And 1%, it's not like a massive thing. You probably get a bigger move on Trump saying something.
Definitely would.
Trump saying how much he hates China. That'd move the market more. Yeah. Anyway, but so that's an interesting bit of news. Like you say, we'll just have to wait and see what happens, I guess. And then let's crack on into the first earnings report. First one we're going to look at is Apple. Apple Q3 2019. They always do this. Apple, they get the quarters wrong.
I was going to say, they're always one quarter ahead, I should say. Which is
do you reckon they make it because then the December quarter, so the December quarter is Q1. And
Yeah.
that's when they would sell most of their like new products. Maybe that's why they do it.
Yeah, I mean, I have no idea why. I believe some companies just do it because, like a very long time ago, that's just the period that they'd been using, and they've just used it for a very long time.
Right.
I mean, I've seen some companies that sometimes have like changed theirs, and it's just a mess because 1 year has only 3 months in it. So it just makes it a mess to like change it after it's been like that for so long.
Yeah,
So
true.
That's probably why.
Yeah,
but
probably.
Yeah, so Apple reported, of course, for their third quarter, and their revenue came in at $53.8 billion, which was up 1% year over year, so not much change
Not
there.
much growth there, yeah.
Yeah, and in terms of the two major segments under their revenue, which is services and products, services was actually up 12.6%, so quite a bit, but their products which is most of their business, was down 1.7%.
Yeah, I was going to say good growth for the services, but services in comparison to products is like the bulk of what they do.
And I mean, services up 13%. I feel like in the recent past they've been growing services at a much higher rate. The rate of growth in services has come down quite a bit. I mean, 13% is still very impressive.
That's good, yeah.
But in terms of their products, one of the major things that pulled down their products section was the iPhone sales, which is actually down 15% in the first 3 quarters this year. So if we're just taking this year's first 3 quarters, 1 to 3, and comparing that to 2018, they're down 15%. So quite a substantial amount.
Did they say that in like the conference call or in the earnings report? Because I just remember them saying that weren't they not going to report iPhone sales data from now on?
They're not reporting the units. So they're reporting the sales, but not the units data, the number of units that they sell.
Oh, okay.
But in the report, they included the first 9 months, the last 9 months, and then the 9 months before that. And it was down 15%, which is quite a lot. But then again, I guess it's just 1 year, so you can't really draw much from that. You've really got to look at longer trends. Yeah. But yeah, 15% is certainly substantial.
Does seem like they're plateauing, well, like they're saturating a little bit now. Yeah. I don't know, because even in the last, year or so, we've seen that the majority of the increase in their revenues has just come from an increased average selling price of their products, as opposed to just selling more. So
yeah, and now the average, like, I don't know what they call it actually, but the amount of time that people are holding on to phones before they buy a new phone, that has extended out.
Oh, really?
Quite considerably from 5 years ago, which is contributing to this, and is actually why Apple is now taking trade-in iPhones, and also why they're trying to expand their line of iPhones rather than just having one that comes out every year. They have a few different ones, I guess, just to try to appeal to people and get people to buy a new one more regularly. But yeah, I mean, all of those things, and just the fact that the market when Apple was dominating in it was very underdeveloped, and now there's so many different phone manufacturers that are coming in, that just naturally is going to add competition and take some of their market share over time. Yeah.
Okay, yeah. So in terms of their numbers, what do we got here? Earnings per share was down, was it?
Yeah, so earnings per share was down, was $2.18, which was down 7% year over year.
Right.
Their equity came in at $96 billion, which was down a couple of percent, nothing major.
Yeah.
And free cash flow for the previous 12 months came in at just under $42 billion, which again was down a few percent. So, so in terms of cash flow for this year so far, the first 3 quarters, fairly unchanged. And then, of course, revenue was pretty unchanged as well. So
free cash flow was for the previous 12 months or the previous 9 months?
Sorry, 9 months.
Oh, yeah.
9 months.
Yeah, that's all right. You just said 12. That's all right. Right, okay. Yeah, interesting. Imagine generating $41.7 billion of free cash flow. That some of these numbers that these companies can generate, it's just phenomenal. I was reading something and talking to one of my friends about just like how much power there is in just a select few, like the Googles or the Apples or the Amazons, or Facebook, just how much power they hold by kind of being their industry leaders. It's pretty crazy, because some of these numbers like that they can pull out are just incomprehensible. Like you can't imagine that many like billions. Just like, it's very hard to comprehend, but yeah, certainly got a lot of money.
Yeah. And that they're doing a considerable amount of, I guess, returning capital to shareholders, right? In this quarter, they repurchased quite a lot of stock.
Yeah.
And they had their dividends. You had those numbers, didn't you?
Yeah. They basically bought back. Well, they returned over $21 billion to shareholders during the quarter, and that was through $17 billion of share repurchases, and $3.6 billion in dividends and equivalents. So the one thing that I wanted to bring up about this particular topic is just to remind people that, it's great that a company does share buybacks and stuff. And, if you hold that company and they do lots of, big share buybacks, then they're clearing shares off the table, which means your percentage ownership goes up. But remember that it's only a good idea for a company to buy back its own stock if they believe that their stock is undervalued, so they're actually getting a good price to clear those shares off the table. Because you can imagine it's almost like, don't imagine the company as its own company, just imagine it like another shareholder. Like by buying back their stock, they're basically making an investment in themselves. So you still want it to be like undervalued when you buy your shares. Because that's the way you return the most value to shareholders. Well, I think basically if it's overvalued and you buy back your stock, it's destructive. It's value destructive for your shareholders, right? And then if you buy them back when they're undervalued, it adds value to your shareholders. But what's interesting is that they've almost just had this policy that we're going to keep buying back our own shares, and the stock's now at almost the highest it's ever been. It's at 208, I think, at the moment. That was yesterday anyway. I don't know what it did overnight. It almost got to 230 in September 2018, but yeah, now it's at about 210. But the interesting thing, like, I haven't done a evaluation of Apple in a while, so it might have changed. But even when I listened to interviews with Warren Buffett, and he said, yeah, sure, he holds a lot of Apple stock and he doesn't mind share repurchases, but he said he's certainly not buying Apple at these prices. Remember, he got in at around the $100 mark. He thinks it's a great business, but he's not even interested in buying at these prices. So you do wonder if Apple just has... they've just got so much cash that they don't know what to do with it, kind of thing. So they're really just trying, all right, well, let's just keep the earnings per share up by just continuing doing our share buybacks.
Yeah, definitely. I mean, if you're producing 40, 50, $60 billion of free cash flow per year, there's only so many investment opportunities that you're going to be able to meet with that kind of cash.
Exactly.
Either it's going to sit as cash on your balance sheet, which Apple already has quite a substantial amount of cash, or you just have to start distributing it, paying dividends, buying back stock if the company believes that the stock price over the long term is going to go up from the point at which they buy it.
Yeah.
And hopefully at a decent rate, not a 2% increase over 10 years.
Yeah.
But it's interesting with these companies because it's the same with Google, Facebook. They just have so much free cash compared to many other businesses who have to put a whole lot of that money back into the company just to maintain it, really. Yeah. Whereas a lot of those maintenance costs for these internet companies, and I mean, I kind of start to classify Apple as one because they've got a significant amount of services there as well. They have a lot of cash just to start distributing back to shareholders.
And that's what I was thinking. Like, this is my personal opinion, right? This company has so much cash and they don't know what to do with it. And you look at how their business has evolved over time, and they've basically got the idea of a personal computer. They've got personal computer technology basically saturated, right? You've got a desktop option, you've got a laptop option, or many laptop options, you've got tablet options, you've got phone options. The services business, yeah, sure, it's increasing, but it's the way I think about it, you've got so much money now, and you kind of a little bit stuck as what you're trying to do with it, so much so that you're just buying your shares back when they're not even at the best price. Is it worthwhile? This is what I've always criticized Apple of. Is it time to look for another thing in the technology space? A lot of people say it could be electric cars, but is it time to use this amazing financial platform you've built for yourself over time to do something different. To like you imagine like the pivotal moment. You ask anyone, what is the most pivotal moment in Apple as a business, their history, and it'll be, it's when they came out with the first iPhone.
Yep.
Because that was just like absolute. That's when Apple came out and they said, "Oh my gosh, this is something revolutionary. You've never seen anything like this before, and it's going to be an absolutely fantastic product." And it was, and it grew their business into what it was today. They need, and this is why what people always say, like Steve Jobs as like a CEO versus Tim Cook. Tim Cook's kind of just like, next year we'll just update our tech a little bit and come out with the new models. Whereas Steve Jobs is the innovator, thinking about, well, what do we need to do? How do we make a new innovative product? And that's what I always criticize Apple about. I feel like now that they've got themselves into like their absolute financial fortress, use that position and do something else to fuel the next decade or 2 decades of growth. Like I was saying, there's a huge talk about whether Apple would start getting into electric cars, but that hasn't really come to fruition yet. But like, just, you get what I mean? Like some other area of business that could be the next big thing for Apple.
Yeah, I've been saying this for a little while, and it's my long shot bet.
Yeah.
Apple's gonna buy Tesla.
Yeah, they very well could do. I mean, they'd wait until Tesla was just like on its knees, though.
Oh, of course.
Yeah.
There's no way. There's any other way they would get the company.
Yeah.
Other than if they were gonna go under.
I was talking to someone just the other day, and they were saying that acquisitions, in most cases, what did they say? Acquisitions are the cheapest R&D. Yeah, because what you can do if you want to get into an area of business, so you want to acquire another business that's in that area, just while the business runs as a separate entity, let them do all of the R&D, and then when they start to struggle, then they've done all of the R&D themselves, and when their share price goes down, then you can acquire that company, and then it's been a cheap acquisition, and they've already done all the R&D. So I found that kind of, I've never ever thought of that before, that kind of thing. But I guess it kind of makes sense. Let them do the R&D, and then if they struggle, pick them up, and then you haven't wasted your money on doing that R&D yourself.
Yeah, pretty much. There was a rumor a while back, I think it was in like 2013, that Apple made a bid for Tesla.
Yeah, and I think
they were struggling,
I think Google has as well. Google's tried to buy them. Yeah.
Just a conspiracy. All these tech companies are hoarding cash, waiting for Tesla to raise the white flag.
Yeah, maybe.
I just think that Tesla and Apple have I think their branding works well together.
Yeah, very
I think
similar.
having Apple interface within a Tesla, having Apple software in a Tesla, I just think both. Yeah, I think it's like a luxury kind of exclusive brand feel that the iPhone's really lost now, because I mean everyone has an iPhone and there's like 4 different types of them that come out every year.
Yeah.
But Tesla's got that still.
Yeah.
It's got that exclusivity that everyone wants, and their cars are not supposed to be overly expensive in the long run, right? The Model 3 at least is supposed to be affordable for most people.
Yeah.
But it's still got that luxury feel, and it's definitely got an innovator running the company.
Yeah, they have that similar kind of cult-like following, that cult-like brand power, both Apple and Tesla. But interesting. We'll just, like we always say, we'll just have to wait and see. Anyway, shall we wrap up Apple and get on to Texas Roadhouse?
Yes, let's do it.
Yeah, this is one for you, because I don't know what's going on with Texas Roadhouse.
Yeah, I just chucked this one in there because, full disclosure, this is a company that I own, so I don't own the whole thing. I wish. Just I own it.
Today we're doing an interview with CEO of Texas Roadhouse, Hamish Hodder.
Yeah, I can't see that at all. No.
Right, so you own the stock, so you're going to hype it up as much as you possibly can because you're going to try and drive the share price up. You're doing a classic pump and dump campaign. Here we go. Revenue was up to $15 trillion. Whoa, this company is a buy.
Yeah, something like that. No, but so they reported They reported their Q2 earnings, and revenue came in at 690 million, which was up just under 10% year over year. So that's pretty good.
Yeah.
Earnings per share, however, came in at 63 cents, which was up just 1.6% year over year. So big increases in their revenue, but clearly they've had some increased costs. And the majority of those increased costs came from two places. One was higher labor costs, which were up 13%. And that's just been a continuing trend in the restaurant industry because of wage inflation, as well as many states in the United States raising their minimum wages,
Right.
which has just led to many entry-level employees getting paid more.
Do you feel like that's something that will continue to go up over time, or is this going up quite quickly at the moment?
I mean, this is completely normal in a business cycle. It's completely normal for wages to fluctuate. There's periods where 2-3 year periods or 1 year periods where labor costs go up and then they go back down. It's kind of just a function of the market.
Right.
So it appears to be a short-term problem, but of course, with all of these kinds of problems, you never know when it's really going to end, when the wage inflation is going to end. But it's certainly pushing down the restaurant businesses in terms of how much profit they're taking and also their stock prices. And then the other big cost was just depreciation was up 13%.
Right.
Yeah, and then in terms of equity came in at 891 million, and that decreased, but it was just due to a change in an accounting rule, so nothing really changed, just the numbers on a piece of paper.
Yeah.
In terms of free cash flow, it was the same year over year, so no increase, and that was at 100 million for the quarter.
Yep.
And in terms of some of the more important sort of specific numbers for restaurants, one of them is comparable sales, which kind of compares the restaurant sales in specific restaurants year over year. So taking out the inclusion of new restaurants, that can obviously increase total revenue. But if we're just looking at
this is an important number that you follow for this particular industry, right?
Yeah, it's super important because it basically tells us how many more people are coming through the door and how much are they spending. So are people spending more when they come back every time, and are there more people coming through the doors, rather than you could imagine a restaurant company that just grows by building more restaurants. That's obviously going to increase revenue, but in the specific ones, maybe there's less traffic every year.
Gotcha.
But in terms of Texas Roadhouse, this came in at 4.7% for their company-owned restaurants, and then for their franchises, it came in at 4.3%, which has been a little bit slower than what they've been seeing over the past 5 or so years. They've been seeing 5 to 6 to 7%, but still very impressive, still well above the market average.
Pretty decent.
And usually you would, if a restaurant if it didn't have any kind of advantages, if it was just a restaurant that wasn't really loved by a lot of people, then you would expect this number to grow at the rate of inflation, because that's the rate at which food costs go up. But because it's going up quicker than the rate that food costs are going up, it indicates that there's more people coming to the restaurants every quarter.
Yeah. Right. Okay. So interesting. And you're saying they're going to repurchase 2.1 million shares, or they have done in this, or they're doing that in this quarter?
So in the previous quarter, in Q2, they repurchased 2.1 million shares at an average price of $53 per share, and the current price is $56, so pretty much no change.
Right.
There's no real benefit from that, but the stock price is substantially lower than it was a year ago. It's down 25% from a year ago. So
cool.
The stock's kind of been going down, they've just sort of been repurchasing shares.
Yeah. Does this company do share repurchases very often? Do you know, by chance?
Yeah. So no. Generally they'll do quite a lot of repurchases when the stock price is suppressed. For a very long time, they hadn't been doing many repurchases. I believe that only in the past couple of quarters they've started to ramp up the repurchases again, and that's just a result of the fact that the stock's been falling because of this kind of short-term labor cost inflation environment.
Yeah, well, it's interesting because that in itself gives you a bit of a hint as to what the management thinks about the situation that they're, or their share price at the moment, right?
Yeah, definitely. And you would hope, or it's certainly true that management would have a better understanding of how long these labor costs are going to increase, whether that's an estimation. I think it's it's kind of a problem that you can't foresee. It's kind of like a recession. You can't predict when it's going to end.
Yeah.
But I'm sure that they would have a better gauge on what's happening. And it's obviously a good sign because I'm buying the stock. So it's obviously a good sign to see that management is also buying the stock. Essentially, that's essentially what's happening. And they also authorized an additional $250 million of repurchases.
Okay.
So, yeah, it looks as though they're probably going to continue to buy stock into the next quarter or the next couple of quarters.
I'm guessing authorized doesn't mean that they're going to do it, though. It's just that they can. They can do it if they wanted to. Right, okay. It would be interesting to see if there's any insider buying going on at the moment as well. That would be interesting.
Yeah, I haven't looked, to be honest.
That's right.
Recently, so I can't really say anything on that regard. But yeah,
no, you keep talking and I'll look it up.
Yeah, go for it. So as I said, the company's down 25%. The stock price, I should say, is down 25% from its high, which was set about 12 months ago. And this has just been pretty much entirely as a result, or it appears to be entirely as a result of these rising labor costs. In terms of the company's revenue and their other costs, their growth has been excellent. I mean, their top line growth this quarter was still 10%, and they're seeing good comparable sales growth. But what's just hurting their profitability is really just those rising labor costs. So if those labor costs were able to go down, then you would expect that companies' profits would substantially rise in the future. And that's obviously what the management's betting on when they're repurchasing shares. In terms of the rest of the business, they're continuing to build out restaurants. I think they're planning on building another 15 towards the end of this year.
Right.
So that hasn't slowed down at any rate, regardless of how much free cash that they're generating at the moment because of the rising labor costs. And yeah, as I said, I hold the stock. So just for disclosure, and I certainly consider the labor inflation cost to be a short-term problem that probably won't impact their long-term profitability.
Yeah, I'm looking at the insider trading too. Doesn't look like there's too much going on, to be honest. There's a buy from the CFO on the 10th of June, but not too much else. Yeah.
I think if
5th of May.
I think we'd know about insider buying because if there was a lot of insider buying, the stock price would start to move, I think. A lot of people probably use that as a metric, as a good indication that it's time to buy.
True.
If there's a lot of insider buying.
They'd probably want to do their share buybacks first.
True. That's a good point, actually. Maybe that's a strategy to not buy back stock individually because it might rise the price. They can just try and hold off, keep it down a little bit longer so they can buy up some more.
Company. Yeah, fair enough. Okay, so that's interesting. Texas Roadhouse seems like all's going not too badly, actually, even though they have struggled with it is what it is with the higher labor costs. So I always find that interesting. Should we move on to the next company?
Yeah, let's do it.
Talk about Netflix. So I got to re-jog my brain. I was looking at this last night. So for Netflix, they've got revenue up to $4.9 billion for the quarter. That's up 25% year over year. So in terms of revenue growth, and if you look at the revenue chart, it's just like powering up. So very, very strong revenue growth. However, with that said, the total memberships curve is really flattening. In fact, US paid subscriptions was actually slightly less in this quarter than in last quarter. They actually lost subscriptions in the US in that last quarter. And with that said, international memberships or international subscriptions only up 2.5% for the quarter, but still up 32% year over year. But what's interesting about that is being up a lot year over year, but not a lot quarter over quarter. It just shows you that curve is flattening out. But definitely for the last year or two, the international memberships has really been their growth engine. They haven't grown as quickly in the United States. Maybe they're hitting maybe a saturation point or something. But now it seems that both of these are slowing currently. So here you go. I'll ask you this question. How does revenue grow really well when your subscription growth flattens?
You raise prices.
Yeah, you raise prices.
And
Exactly.
they did raise prices in the previous quarter, I think. So I wonder if that had any impact on this. But I guess in terms of Netflix, I would say quite a lot has changed in this space over the past 12 months. I mean, Apple, I'm not sure what Apple is doing actually, honestly, in this space, but
Apple
they're starting
TV,
to they're starting to build their platform in terms of just direct to consumer, I should say.
Yeah. It's
YouTube
mainly,
has their
I was going to say it's mainly YouTube, Amazon, and Disney. They're the three big boys that are bringing video content on the internet.
Yeah,
as well as Netflix.
For the first time, we're seeing YouTube and Amazon and Apple and Disney's coming out this year start to really ramp up their position in this market.
Yeah, massive.
And up, we didn't really see that, I would say, 2 years ago. So that's certainly having an impact. And I'm real excited for Disney's platform to come out and destroy Netflix.
Well, that's the thing, and this is the interesting thing. Netflix versus Disney, I know I've spoken about this a lot before, so I won't talk about it too much. But Disney can leverage the fact that they've got other revenue segments. Netflix just has this one revenue segment. It's just paid subscriptions. Like, if they don't get more subscribers, if they don't raise their prices, then that directly impacts their whole business. Whereas Disney has the parks and resorts, they've got the studio entertainment, they've got the media networks. So it means that they can use the fact that they know that they've got those other revenue segments, so they can be super aggressive in the space of the streaming service, because like for Disney, it doesn't matter if they don't run that very profitably, as long as they're taking lots of market share. And that's what they're doing. They're deliberately undercutting Netflix on price. They're targeting the market share. They want the market share. And they're going to use the other areas of their business to be the cash generators while they run the direct-to-consumer not unprofitably, just so that they can get that market share. And Netflix, they won't be able to do anything about it, because they can't do that like Disney can. They can't go to their media networks. They can't go to Netflix land. This just doesn't exist. They just do one thing, and that's what we always talk about: diversification of income.
Yeah, and one thing that we haven't seen at Netflix a whole lot of yet is price raises. And one of the things Warren Buffett says quite a lot is, one of the best indicators of an advantage is that if a company can raise their prices and still see increases in the number of volume, the amount of people buying the subscription or buying the product. And we've seen one increase from Netflix, I believe, but other than that, they really haven't been increasing their prices yet. So it'll be certainly interesting over the next couple of years to see if they continue to raise their prices to pull in some more revenue and try and increase their margins a little bit, to see what happens with the subscribers. Do people stay, or do people duck out and go over to Disney, which, as you said, can keep prices really low while they're generating cash in their other businesses?
Yeah, exactly right. And what's interesting, you raised that point, is that they have now done one price increase, and that has directly, we've seen that flatten their growth curve of their subscriptions. So, they're still growing, but at much, much less of a rate. So that's interesting. But anyway, what else have I got here? So, what did I find? They've stopped the growth in their operating expenses, which is really good, and that helps with their gross margins. Over the past 3 quarters, their gross margins have been increasing. Now it's up to 38%, which I feel like a pretty decent gross margin.
Yeah.
But the other thing that I always talk about with Netflix is that they just take on so much debt. They take on just ridiculous amounts of debt. It's crazy. So they've added, just in the last 6 months, they've added another $2.5 billion in long-term debt, and they're now up to $12.5 billion of long-term debt. And this is from 2018. Their net income was only $1.2 billion. Right, there's $12.5 billion of long-term debt. Plus, you think if there's any sort of impactful recession around the corner, and just it gets real tough for Netflix.
Yeah.
But they've said in their reports in the past that they have to keep taking on debt, and they will keep taking on debt as they transition their business from a business that offers content that they just they pay for the license from other content owners. Because now the content owners are making their own platforms, so they've lost that option. So they have to take on debt because they have to make their own original content. And that's what we're seeing with Netflix. Now you won't find too many of the Disney movies on there anymore because they're all going back to Disney, and instead you're seeing things like, Stranger Things Season 3 coming out, and all of their original movies and their original content, because that's really, in the long term, the way to win in this space is you've got to hold the IP, you've got to hold those properties, you've got to have that, not the brand of your business, but the sub brands like the Marvels or the Star Warses, Pixar's. All three of those are Disney. I mean, you have to have those brands.
And the interesting. Yeah, I was just going to say, one of the interesting things will be that, of course, Disney licenses a lot of their movies to platforms like Netflix and to cable networks in order to generate revenue. And a lot of these would have quite long contracts, probably, maybe 5 to 10 year contracts. Mm-hmm. So even when Disney comes out with their platform, over time, I'm assuming that Disney would slowly let some of those contracts expire and then pull in their data and make it more exclusive. So
and in some instances, sorry, just to butt in, and in some instances, they're actually negotiating deals where they pay out the license. So they actually want it back sooner. So they're actually paying the companies to get their content back exclusively.
Yeah.
Yeah.
I was just gonna finish by saying it certainly Disney's platform when it launches will be really exciting, but over time it will become more powerful as they start to, I guess they obviously own it, but they'll have more exclusive content to be able to provide on that.
Yeah,
definitely, and of course that will hurt parts of Disney's other businesses, their licensing business, but it should be a net positive considering the margins that these companies see on direct to consumer. That's the other thing, is that Netflix's margins are good, their gross margins, but they're having to spend a lot of money to buy content to generate that revenue, whereas something like Disney doesn't have those costs for many of their stuff. They don't have to license things, so they can just use their own content, which means that their margins are going to be a lot better than other companies or other cable networks that have to just license everything in.
Exactly right. They've already made their content, and even if they didn't have any content, they've already made their film studios. It already exists. Whereas that's what Netflix is like, shit, we got to build this stuff now because we got to do this ourselves. Yeah. Anyway, but that was Netflix. That earnings report was actually from a couple of weeks back, I think. And we should leave it there. I think we'll head on to our last one of the day.
Yes. And
talk about Beyond Meat. This is a really interesting story. And to tell you the truth, before yesterday, I had never even looked into this company. So I'm very much a Beyond Meat noob. But essentially, if you don't know Beyond Meat, like what I was yesterday, trying to research what this company does, they pretty much sell fake meat. So they sell plant-based meats that are not like, I know what you're thinking. You're thinking like, veggie burgers. But they're actually not trying to give vegetable-based meat substitutes. What they're aiming to do is use plant-based proteins to actually recreate, like very closely recreate, the real meat texture and taste. So they're not just making veggie burgers. They're actually real, and like I think they make like sausages, for instance. They're whatchamacallit, like German sausages or something. So they try and use their technology to replicate the taste and the consistency and texture of meat. But what's interesting about the company is that they had their IPO in May 2019, May the 2nd, 2019. Initially, their IPO share price was $25. And currently, their stock price is $196. And
Wow.
and that's after they took a 12% single day loss about 2 days ago. 12% loss in one day, and they're still at 196. I think this stock got up to $230 something.
Wow, almost a 10x on IPO.
Whoa! And it's since May. It's since May.
It's like
It's
3
ridiculous.
months.
Yeah. Anyway, absolutely unreal. It gives them a market cap right now of about $11.7 billion, which is pretty crazy. Anyway, so in terms of their quarterly results, they actually released their results, and the operational results of Beyond Meat are really quite impressive. Like, you look at the results and the growth of, say, things like revenue, like, oh wow, that's actually really impressive. But what's crazy is the price. The price is really just beyond comprehension.
Beyond comprehension. This company must be producing billions and billions of dollars of revenue. Go on, tell me.
Yeah, exactly right. Well, here's the thing. In terms of revenue, you look at the growth. I mean, this is classic. This is like just showing what people are willing to pay for a new growth story. Because you look at revenue growth, it's up almost 300% year over year.
Whoa.
Yeah, so it's a massive explosive growth phase. It's up to 67.25 million. That's it, million with an M. Yeah, this is where we start to see. But it's up to 67.25 million in the last quarter, compared to 40 million in the previous quarter before that, and then 17 million in Q2 2018. So pretty crazy, but this is actually the first quarter of positive operating income for Beyond Meat. And guess how much they made in operating income?
$2.2 billion.
2.2 billion? No, 2.2 million. Million with an M. Million. Still a big number, but certainly not in the billions. So they're starting to make a little bit of money, but this is a company that is now worth $12 billion, and they just made $2.2 million in the last quarter. So, yeah, I don't know.
That's
What are your thoughts?
I just can't get over the fact that a year ago they were making 17 million in revenue. That is so small.
Yeah.
That is so small.
It's remarkable revenue growth. It is. That's one thing you can't take away. It is remarkable growth. But the share price is growing at a much faster rate.
It's a perfect example of people buying a company and just not thinking about how much cash they're actually going to get out of it. They're not thinking of it like an investment. It's just a pure speculation.
Yeah.
Because if you really think, okay, how much could I get out of this company over the next 10 years in terms of cash flow? Well, they barely just made $2 million, and you're paying $11 billion. Yeah. That's just, I don't know what the price to earnings on that is, but it's a lot.
And the interesting thing about it is that people are buying into this company. Really, obviously, when it gets to this point in time, it is speculation. They're buying into the company because of an idea, some story, right? They see a story playing out into the future. And in this case, the story is that this is really almost like a revolution. Like, I know there's plant-based proteins and that fake meats out there, but this is like the first company that's really taking it, along with, I think, is it Impossible? The Impossible Burger over in the States?
I think so, yeah.
They're the only two companies that are really taking it seriously in making things that taste like real meat, like properly real meat, but aren't made of animals. So, but this is, I actually watched this. So that's what they kind of think. That's their kind of competitive advantage. Is they're kind of like a first mover. But this is what I think. And I was watching Gally Russell from Hyperchange. We had him on the podcast ages ago talking Tesla, but I was actually watching a breakdown of his quarterly analysis of Beyond Meat yesterday. So I'd really encourage you guys to go check that out on his channel Hyperchange, because it's a really solid breakdown, and he kind of draws the same conclusions as what we're drawing here. But the one thing that he was talking about is the thing that doesn't work for him is he doesn't see a sustainable competitive advantage. And the reasoning he gave for this is that at the moment they're only spending about 4 million with an M in R&D per quarter. And he doesn't think that that's anywhere near enough when you think about, he mentioned two companies like Chipotle and McDonald's. You just imagine if they wanted to do this as well, how much money they could put into R&D per quarter if they just wanted to basically completely recreate the same product that Beyond Meat makes currently. I mean, they could put in 10 times the amount, 20 times the amount into R&D per quarter than what Beyond Meat is currently doing. So the way that Gally saw it is that he doesn't think that there's enough being put towards R&D to keep what they've currently got as a bit of a competitive advantage. He doesn't think that they're going to be able to keep it.
Yeah, it's another sort of case of a market that's really underdeveloped, and a couple of businesses come into that space and absolutely dominate it, and it looks amazing. That's my opinion, at least.
Yeah.
I kind of see Beyond Meat and the Impossible. They're really the only big corporations, big air quotes because they're not that big, but big corporations that are doing this and supplying. But you're right. If it really doesn't take that much money to develop these things, then it's just, you shouldn't. It's like why it's such a bad idea to invest in new industries, because you don't know how it's going to develop. And as soon as the big companies switch on and find out that there's money there, they'll just pile billions of dollars, not millions, billions of dollars into R&D. If the money's there to be made, that's going to make, because the company's worth $12 billion. So if it can really produce, close to that much or more in cash flow, then there's going to be big companies that are going to want to come in and try and take some of the market share. Have you tried any Beyond Meat or Impossible?
No, I haven't. I can't say I have, to be honest. Can't say I have, but I'm thinking I might have to. I don't know if their products are available in Australia, because they have like restaurants and stuff, and then they have frozen like grocery store products as well.
Do you have a fast food chain in Canberra called Lord of the Fries?
Oh yeah. Oh, do they use their stuff? Do they?
So they're normal. So like it's a vegan fast food restaurant for people who don't know. But they make burgers, and they look like and they taste like hot dogs and meat burgers. Right. But the normal meat that they use is not Beyond Meat, but you can pay extra for an add-on to get Beyond Meat. I think it's just because it's outrageously expensive. I mean, it was like $12 for like a little hot dog if you got it with Beyond Meat, and then it was like $6 without it. So it was a huge increase to get it, but it's good. I'll tell you, it's good.
Oh, there you go.
I could barely tell the difference. You can tell the difference.
Yeah.
But
like
barely.
Just.
Yeah. And I mean, I don't know. I'm the kind of person who I wouldn't mind as long as it's got the same nutrition. Like, I particularly like burgers, so I'd love for I'd love for there to be like replicas.
Yeah.
So that I could still do it. But I mean, I don't care if it's an animal or not.
Yeah, exactly. In fact, to be honest, if they can make it taste the same as meat, I'd prefer to not eat the animal.
Yeah.
Yeah.
I'm 100%.
Yeah. Like if it tastes the same, if the texture is the same and it tastes the same, I'm happy to have a plant-based protein. Plus, you could probably look at some health studies. It's probably healthier for you too.
Yeah, that's the two big things. Like, it has to taste good because I love burgers, and it has to be similar nutrition, if not better. That's
I want to go get a burger. Maybe I'll go get one for lunch.
Uber Eats.
Too expensive, man. Too expensive. And I don't know, from where I am, I always go onto the Uber Eats app, and it's like everything seems to be unavailable. It's like just at the time when I want to get some food, everything's just, no, you can't have it. Sorry.
I'm in a bit of a dead zone as well.
Are you?
There's not a lot of like restaurants and places
What's
nearby.
that new one? The new one, Menulog or something that's come out recently?
No, it's been out for ages.
Has it?
It's just starting to pick up some steam though. I think I've had that. I had that longer than Uber Eats.
Oh really?
Yeah.
Oh okay. There you go. Maybe I've just seen their ads more.
Yeah, they started pushing the marketing. They caught on.
Their
Uber
ads
Eats
are so annoying.
It's so bad.
So annoying. Anyway, welcome back to the podcast, everyone.
It's got nothing to do with this.
Welcome back. Please leave a comment below. Where's your favourite place to go and get a burger? I think that just about wraps us up for Beyond Meat.
yeah, that's just about it. We've got some Q&A, don't we? We have one.
Yeah, we'll do a couple of Q&A questions and then get the hell out of here. So we got two. We'll go through two Q&A questions just to round out the podcast. The first one is, I have a question regarding super. As the market is at all-time highs, it may be risky to enter the market in an ETF. What would you think about holding super in cash rather than having it invested? And usual disclaimer, we cannot give individual financial advice. But, I mean, it depends on your strategy always. I mean, if you're a true passive investor, then the dollar cost averaging strategy, the true dollar cost averaging strategy is you invest the same amount at the same time intervals and you just keep going and you just don't stop. And then you're trusting it in the long term that it'll make you more money based on what has happened in the past. And you got to remember that if that's the way you invest, then that's the way you invest. But if you start to mess around with it, then you are just by definition starting to be an active investor.
Yeah.
So, I mean, like, it's not our place to say what you should do or what you shouldn't do. Of course, I think both of us, we subscribe to, in part, passive investing and in part, probably in most part, active investing. So we definitely think that there's two ways you potentially could think about it.
Yeah.
What would you agree with that? Is there anything there that you wouldn't agree with? Or?
Yeah. So in terms of passive investing, what I do at least, when I'm passively investing, I just try and not time the market at all. I just try and buy at the same intervals with the same amount, and just don't have any part in timing the market, because I think that it's pretty consensus that if you try and time the market versus just being in the market, time in the market over the very long term, you're going to lose most of the time, because what you think is evidence of being able to time the market is often wrong.
Yeah.
Because we often use our emotions. Or it might be right,
or for some reason it doesn't come to fruition, because that can always happen. Like we've seen overpriced markets for like the past 3 years, and it's been charging up and nothing's happened yet. So
yeah. In terms of active investing, I guess you could kind of say that I try to time the market more, but it's not timing the market where I'm selling because I think there's going to be a crash. I just look at the individual business's price and I compare it to what I'm getting out of it. And if the price is ridiculous compared to what I'm actually going to get out of the company, then I'm willing to offload that to someone else and have a little bit more cash. But in terms of ETFs, and just overall, I guess, just to summarize, like you always want to be at least somewhat in the market, because over the long term, the market is going to way outperform your cash.
Yeah.
At whatever rate that is.
It's just about, a bit of a balancing act, especially if you got a super account that can give you different options and you can hold part cash and part, I mean, it's really up to you. It's just whatever strategy you want to subscribe to.
Yeah.
Yeah. All right. Last question here. What platform do you guys use to invest in the American stock market from Australia? What are you using? You're using CommSec, aren't you?
Yep. I just use CommSec International.
Yeah.
It's pretty easy to set up. I think there's maybe 1 or 2 forms that you need to fill out.
Yeah.
Some tax form, and then it's set up. The platform's not great. It's pretty slow, I would say, but I don't use it to research or anything like that, so it's not really a problem for me.
Yeah, it's really slow, isn't it? It takes forever to load that page.
It's really odd. I don't know why that would be the case either.
Yeah.
Why couldn't they just have a local website and then do the I don't understand what's going on there. Like, what are we hooking into when we go on that?
It must be a technicality. Yeah. Yeah, I don't know either, but yeah. No, I've definitely used CommSec International in the past. Of late though, I've been using Stake, and disclosure, they're one of the channel sponsors, but like, you guys know that I don't recommend anything, or I'm not sponsored by anything that I don't also think is a good product. So I've been using it and it's been working pretty flawlessly for me so far.
Go on, what's the code?
What's the code? Oh, yeah. AWC. If you download the Stake app, I think at the moment you get $10 off your first trade. But the only thing, I tell you, the one thing that's killing me at the moment is the flipping exchange rate. Oh, my gosh. It's just, and this is no matter what platform you use, obviously, because it's just a currency exchange. But man, it hurts. It hurts. I really wish I'd put more of my money into US dollars a little bit earlier. But do you hold like some US dollars, some Australian dollars?
Yeah, I was actually quite lucky I put quite a lot in US dollars about 2 years ago, actually. A year and a half ago, maybe.
Man.
I made a really high return on it. It was actually pretty ridiculous. I think I made maybe 11 or 12% on cash.
Wow.
Which is outrageous if you think about it.
Jesus. Yeah. Oh my gosh. It's $1 currently equals $1.46 Australian cents. Oh.
The thing, at least, is that if the US is now lowering rates, that should make the Australian dollar a little bit stronger against the US, and that should sort of come back a little bit. But that would mean that you'd want to be sitting in Australian dollars. That would mean I'd be starting to lose some of those gains on.
Yeah, so that's not
US
what you
stocks.
want.
It's not what I want, because I hold US stocks and I have to sell them in US dollars. So obviously I want the US dollar to be as strong as possible. But yeah, what can you do?
Yeah, what can you do? You can listen to our podcast each and every week.
Yep.
Thanks for listening. That was my perfect segue into finishing the podcast.
Nice. No, yeah. Thanks everyone for listening. I just remembered this was my podcast, so I've got to do the outro for this one. Thanks everyone for tuning in, and if you have any companies reporting earnings next week and you want us to cover them, then go over to youtube.com/Hamish Hodder and find the video version and leave a comment there. But other than that, thanks for joining me, Brandon.
That's all right. Thanks for having me on as always. It's been good. I think we got to talk about Disney next week. They haven't reported yet, and there might be one other that I'm forgetting, but I can't remember. So yeah, it should be. We'll make sure we cover that stuff next week as well. But we'll probably have less companies to cover, so we'll probably talk about something else as well. And yeah,
that's it. See you later, guys.
Cool. All good. Yep. We'll see you guys next week.
Class dismissed.
All right. Bye, everyone.